I think, Frank, we can start the meeting.
Yes, ED, and good morning, everyone. Unfortunately, my camera is not working, so I'll be having a bit of a technical challenge on that side. But I would like to welcome everyone today to our webinar, our post-budget webinar, which focuses on implications of the 2025-26 tax measures on regional trade and investment. And our main objective today is to provide insights into the uniformities and disparities in the application of tax measures, including the EAC CET by EAC partner states and their impact on EAC trade and investment across the region. So we'll have a number of speakers for today. We'll be having our EABC Acting Executive Director, Mr. Adrian Jau, giving some welcoming remarks. Later on, he'll be followed by our Honorable Chair, Mr. John Luala Cole, who is going to give his opening remarks. Unfortunately, we expected the EAC to participate, but the DSG is on another duties, so they will only be doing the presentation. We have a principal customs officer, Mr. Jonathan Sesanga, who is going to give a presentation on the overview of the EAC common external tariff, the disparities and business implications of these disparities. But we will lastly have a presentation from tax experts from PwC, covering countries of Kenya, Tanzania, and Uganda. So they will mainly give us the different tax measures that have been pronounced in the Finance Acts for this year, but also the impact of those particular measures to market competition, regional value chains, and intra-EAC trade. After those presentations, we'll open the floor for questions, but we also encourage participants to use the chat box or the chat room to also pose their questions in case they have any questions as the presentation is going on. And once we open the floor, we'll give you the opportunity to voice your concern or your recommendations. So with those very brief through the program, I would like to take the opportunity now to welcome Mr. Adrian Jau, our Acting Executive Director, to give his welcoming remarks.
Okay. Thank you very much, Frank, for the introduction of our webinar. Chairperson, representative from EAC Secretariat, PwC, our partner in this webinar. Ladies and gentlemen, good morning. It is honor to welcome you to this critical post-budget 2025-26 webinar on implication of the Customs Union 2025 tax measures on the EAC trade and investment. I would like to extend my gratitude to EAC Secretariat, PwC, for joining us in organizing this workshop, but also to all participants and our esteemed members for participating, for finding time out of your busy schedules to join us today. The EAC Common External Tariff is an essential instrument for EAC Customs Union Protocol, aiming at facilitating trade and creating level playing field in the EAC customs territory by providing uniform tariff structure. However, the existence of numerous stay of application and country-specific duty remission, as well as adjustment in each year, has diluted its effectiveness. These measures, while intended to serve different national aspirations, have indefinitely distorted regional market as they tend to create a level playing field. As EAC consolidate the achievement made in progressive implementation of customs union and common market, as you find that the customs union, we have been implemented it for 20 years, it is high time we address the challenge which are inhibiting uniform application of the common external tariff, but also preventing private sector from taking advantage of EAC integration. So from this webinar, the private sector is requesting the partner state to make sure that our budget process actually enable us to implement the EAC commitment in the integration. And in order to fully implement a single custom territory, we are requesting the partner state first to ensure all EAC partner state uniformly apply the agreed EAC common external tariff, eliminate all discriminatory tax measures on EAC originating goods, especially for goods which are transferred from one country to another. And to eliminate these discriminatory tax measures is where the partner state is supposed to treat the similar or like good of domestic, same as the way for the goods which are coming from other EAC partner state. But also, it is high time for partner state to remove all charge of equivalent effects, levies, and fees which are imposed on EAC originating goods. The fourth one is to harmonize the pre-budget consultation across the EAC partner state, where we can have a similar circle across the EAC partner state before we come up with the pre-budget consultation at the regional level. This is very important because when you look, for example, the adjustment of the tariff in EAC, almost each year is about 40% of the tariff line must be changed for different reasons across the EAC partner state. So those are my remarks, and I wish all the participants to make sure that they contribute in make sure that we harmonize our tax measure, and when we are coming up with a budget, we make sure that the budget does not contradict with our EAC treat and the protocol, like a protocol on customs union and the common market. Thank you very much and welcome for the webinar.
Thank you, ED. I would just like to take the opportunity now to welcome our Honorable Chairperson, Mr. John Lual Akol, for his remarks. Karibu, Chair. Chair, we cannot hear.
Yeah. Hello. Good morning.
Good morning.
Thank you, ED. Thank you, Secretariat. Our chief guest, who is in absent, Deputy Secretary, General Custom, Trade and Monetary Affairs, EABC Board Directors, EABC Goodwill Ambassadors. I don't know if they are there today. EABC Acting Executive Director, distinguished CEOs and directors, media, eternity, chief guests, ladies and gentlemen, good morning and warm welcome to 2025-2026 EAC post-budget webinar on implementation of 2025-2026 tax measures, regional trade and investment. It is my privilege on behalf of the EABC to address you today as we convene for this webinar in participation with the EAC Secretariat and PwC. These webinars provides a critical platform to reflect on our shared visions for harmonization and tax environment that drives regional trade, investment, and economic prosperity across the EAC. The simultaneous budget reading in June 2025 conducted under the EAC Treaty, the Common Regional Theme, underscore our commitment to integration. However, as highlighted during our pre-budget webinar, persistence disparities in the implication of the EAC Common External Tariff, TT, coupled with the country's specific adjustment and requests for state of application, SOAS, and the duty remissions continue to create inconsistencies that hinder seamless trade. These challenges affect the market competition, disruption regional value chains, and increase the cost of doing the business, particularly for the private sector. Drawing from challenges, we recommend the partner states: 1. Uniformly apply the EAC Common External Tariffs to ensure predictability and fairness trade. 2. Refrains from introducing the tax measures that contradicts the aspiration of the EAC regional integration frameworks. Number 3, promotion dialogue between the public-private sectors in shaping tax policies and elimination of the tariffs on non-tariff barriers that undermine the EAC trade. This webinar aims to deepen our understanding of the tax measures, their implications for their business, and their diversion persist across the partner state. More importantly, we seek to amplify the private sector's voice, gather our views on the challenge and opportunity. This increase the present. I urge all the participants to engage actively, share practical insights, and provide recommendations that will foster a unified, business-friendly tax framework. Thank you for joining us, and I look forward to a dynamic and productive session. Thank you so much.
Thank you, Chairperson, for those wonderful remarks. And now I think we can go straight to the presentation. So let me take the opportunity to welcome the Principal Customs Officer from EAC Secretariat, Mr. Jonathan Sesanga. You are warmly welcome to start the presentation.
Okay, thank you so much. Hope you can see my screen. Good morning, everybody. I'm called Jonathan Sesanga. I'm the Principal Customs Officer in charge of information technology. I'm going to make a presentation on the new tax measures that were announced at the beginning of July. That's the beginning of the new financial year.
Sorry, Jonathan.
Yes, hello?
If you may put your presentation on full screen mode, please. Presentation
yes,
mode.
I'm going to do that. Yes.
Okay.
Yeah. So I think let me also remove the camera so that it flows. Okay. So thank you so much. As a way of introduction, the objective of this webinar was to present the newly approved this common external tariff measures for the financial year, which began in July, and then also to discuss how these disparities are in the application are impacting regional trade, and then also to gather the private sector views on policy risks and challenges that arise from the new measures. So that's the outline of my presentation. I'll take you through the framework, the highlights of the measures, country-specific measures, implications, and then maybe the key discussion points that probably need to come out of this meeting, and maybe propose solutions. So to start with, I just want to start with the pre-budget consultations. Before these measures are submitted to the EAC for consolidation, there are pre-budget consultations which take place at the national level, and these are guided by the Ministry of Finance, together with the implementing agencies, mainly the revenue authorities, and then they are submitted to the EAC Secretariat for review and consolidation. Then the recommendations are made on what needs to be submitted for budget inclusion, and then the Council of Ministers approves these measures through the legal notices, which are published on the EAC website. So that's how, in short, the process is structured. And I hope in the national consultations, also the private sector is consulted during this process. So basically, the national partner states submit their proposals, and then we consolidate into the gazettes. Now, the common external tariff framework is a key feature of the customs union, and it was designed to harmonize import duties across partner states, apply a common rate to imports from outside the EAC. So goods coming from outside the EAC, there is a common rate for each of the items that are imported to ensure that the uniform treatment and prevent trade deflection. Again, another objective was to protect regional industries by imposing higher tariffs on sensitive products, while enabling cheaper access to raw materials and capital goods through lower tariffs. So at a high level, the tariff is structured under 4 bands. There are those goods which are zero rated, mainly raw materials, intermediate goods at 10%, finished goods at 25%. But there are also sensitive goods which range between 35 and 100%, or specific duty rates. I'll elaborate that as we proceed. Now, why do we have deviations, which are which come in through the request for stays of application or duty remissions. Now, the reasons which are provided for the submissions, one is to protect the local industries which are still growing and to ensure domestic, maybe food security and other essential items which are probably might be in shortage, and also to safeguard the critical fiscal revenues. Now, to come to the measures of this financial year 2025-26, these are contained in legal notices, but specifically that legal notice number 171 stroke 2 2025, which was issued on 30th June 2025, and again highlighted in the National Finance Acts, because the national budgets of the different partner states, whatever measures that have been put there regarding international trade, they come from what has been agreed on. So they're incorporated in national budgets through the National Finance Acts. As the EABC Executive Director mentioned, that according to the current requests that came in, 40% of the tariff lines were adjusted, either upwards or downwards, which constitutes like 41%. These are the variations from the tariff. And it's actually a mixture of requests. Some of them are requested for high duties on sensitive products, which have been raised from some rates which are lower up to maybe up to 60%. And then there is also zero rating or reduced rates on capital goods and green transport. Then there are also hybrid requests, whereby an ad valorem rate of, say, 35% is applied, or a fixed rate per metric ton is applied, whichever is higher. So these are the different types of states that have been requested. But also there are also targeted duty remission schemes for inputs and raw materials, particularly for garment, footwear, furniture, suitcase, just to mention a few. And as I mentioned that the increase, for example, in duty imports, the objective is to protect local industries. Reductions are aimed at provision of capital goods and maybe also provision of essential goods. And there's duty remission, targeted remissions to benefit from raw materials. Now, this is just an extract, a sample of what, but there are many tariff lines if you go through the detailed gazette, but this is just an extract to highlight what the point I'm making, that for Uganda, you see some of the goods, the stay of application is was requested from the current 35% to say 60%, some of them from 0 to 10%, and then some of them from the current duty of 25 to 0. And the reasons are given there for these requests. So which range from what I've just mentioned, that there is need to protect local industries, boost agriculture through maybe you increase the rate so that somehow it prohibits the importation of some agricultural produce in order to protect local farmers' production. So at a high level, these are some. This is just a sample of the extract. When it comes to the other countries, Kenya, they also have the ad valorem and the fixed rate, whichever is applicable, and the objective is to protect local industries. There's also to protect assemblers of trailers. That's the high-level overview of what has been requested by the different partner states. Maybe which is summarized in this slide and the rationale, as I've mentioned. Rwanda specifically requested for, say, 0% for electronic vehicles. And the objective, for example, is to promote green transport. And Tanzania, they also requested for 0% import duty for smart cards. I think this is to protect digital services. Maybe I think the national registration of national ID registration, and also to promote the bus rapid transport. I think basically in Dar es Salaam, there is need to import those buses at 0 rate. So, and others, for example, Uganda, there was an increase of 10% on mobile phones from 0 to 10%. And probably maybe this is for fiscal purposes, or maybe for also purposes of promoting digital industry, which are coming up. So maybe what I need to point out that Uganda had the highest rate of 60%, and it's mainly recovering probably agricultural products, that the increase up to 60% is to support the agriculture sector: tea, coffee, frozen meat, peanuts, dairy farm, and other sectors. So there are different definite variations in terms of the requests, and these are the reasons that they are provided, which are national in nature in terms of the rationale. Now, what are the implications of these measures? As I mentioned, there are positive definite implications. First of all, is to protect local manufacturers, and maybe it's an incentive for local production through duty remissions, that you assist local producers get raw materials and other inputs at a lower cost by asking for duty remission, and maybe by also imposing higher duties on some sectors or goods. It also helps the manufacturers of those goods under those sectors to have leverage in terms of cost reduction. But now, from a business perspective, there are also some challenges which arise from that. That first of all, it creates a higher farms which are dependent on imported finished goods or parts will face higher costs. If, for example, a country increases a particular maybe rate for particular goods, but you may find that again, even if you are protecting local industries, if the raw materials sourced within the country are not sufficient, you find that maybe the inputs will go high. I mean, the cost will go higher. There's also an effect on the consumer prices, especially if you, as I mentioned, for example, like Uganda is protecting, has requested for increase in the duty rates for agriculture or which are produce. This might have, just in case there is no sufficient production of those goods, definitely the need for importation of some goods during the period of the stay, the items will be at higher price. So basically, that's one of the challenges of these high tariffs. Now there's also the frequent stays of the it rates reduce predictability, which complicates long business planning. Yeah, this is now to investors, such that you need to know that if an investor is planning to invest, or already an existing producer is planning to expand, maybe increase on investment. Now, because of the stays, for example, if you are producing good in one country, but then you find that the stay has been reduced to zero, which allows a flooding of the goods from outside, this might impact the goods that would have been coming from other partner states. So this is the effect of some of these measures. So now, as I mentioned, that countries have their justifications. So the states reflect national priorities, but may undermine the uniform application of the CET, potentially harming regional trade. It leads to arbitrage and might even lead to trade diversion. I think I already talked about this, the challenges of the stays, the positive. This is now at sector level. Maybe some sectors are boosted, others might be affected. Probably maybe what I also need to bring out that on the positive side, you may find that some countries now are trying to they are driven, the incentive, the rationale is driven by environmental factors, like, for example, importation of electronic vehicles. The objective is to come up with green and mass transport. So now these are some of the things we need to look at. That it's a dedicated situation where you cannot say completely no and then completely yes. But now, how do you move in the middle there? So this is what actually I've been highlighting, that one of the challenges that might arise is that, for example, if cases are arisen where you find that a particular country might ask for either duty remission or stay of application, but even at the end of the period of the request, there are at times some accusations which come that maybe this particular, say, manufacturer stocked a lot of raw materials under duty remission. So even if you move into the following financial year and already this particular maybe manufacturer is no longer benefiting, there are times when accusations might arise that which might result into denial of market access. So these are some of the things which normally come up to the Secretariat, and we carry out studies to see how they can be resolved. So this it has an impact on trade, and definitely resulting in denial of market access. So as I move towards the end, that what should the webinar reflect on in terms of private sector and the policy dialogue priorities? That probably the private sector should deepen understanding of why partner states deviate and how it impacts their businesses. However, we are proposing that maybe there's need to do some more structured consultations before pre-budget cycles, so that there's a deep involvement of the private sector in these consultations. So in order to arrive at the appropriate maybe measures. So there's need also to build consensus when it comes to maybe a joint industrial mapping to decide products that genuinely require protection. And because the objective here was that under the customs union, that countries which have an advantage or a comparative advantage over others will be supplying goods and products to others. So maybe before a particular partner state asks for a stay of application, probably there's need to find out whether that particular product or input that is required for production in another country is not available in sufficient quantities. And this will ease or will help in the reduction of the stays of application. Now, these are just questions we need to maybe, as stakeholders, need to probably internalize that. Are these new tariff structures aligned with the regional industrialization, food security, and revenue objectives? Could repeated prolonged stays deter long-term investors needing predictable regional supply chains? And how can partner states better coordinate industrial and tax policies to prevent harmful industrial intra-regional competition? Probably if some of these questions are answered, they can ease in the policy formulation. Also, in summary, the EAC framework objective is to harmonize tariffs and foster regional industry. But these measures show continued use of country-specific states to address domestic economic concerns, where this flexibility helps in protecting sensitive sectors and encourages local value addition. It also risks undermining the uniformity of the customs union and may increase costs for businesses relying on imports. And finally, what are the key strategic recommendations provided for EABC? That there is need to safeguard CET uniformity. There is need to advocate for clear regional guidelines and timeframes on stages of application. And probably maybe this needs to be eased out gradually in the next 3 years in order to protect the predictability of the CET. So there's need to push for annual reviews to ensure states do not distort intra-regional trade. There is also need to harmonize duty remission to promote EAC-wide duty remission or drawback for industrial inputs to level the playing field. And this will encourage uniformly low tariffs on raw materials. So this goes back to what I was saying, that maybe there's the regional need for regional mapping of the industrial objectives and strategies. Now, when it comes to maybe as we move into this electric vehicles and also promotion of the green environment incentives, probably there's need to support common incentives, CET incentives for electric vehicles and green technologies that foster balanced uptake across EAC markets and stimulate regional investments in assembly and sustainable transport. And finally, to facilitate structured dialogues with the national chambers to monitor the impact of high tariffs on consumer prices so that they collaborate with the EAC Secretariat on joint impact assessments to guide future CET adjustments. So thank you so much for listening to me. And I've come to the end of my presentation.
Thank you very much, Jonathan, and also for the wonderful recommendations. I think you go through the charts. There was one question regarding we will respond to this later on, but someone was just asking with the changes that are happening in the US by imposition of taxes on some of the unfriendly states, what would the EAC members do to take advantage of any opportunities that arise from that? So Jonathan, will have questions at the end so that we get more time for presentations first. So just ask you to stop sharing and to request colleagues from PwC to proceed with their presentation, and we'll take questions at the end. So Johnson and your team, welcome.
Thanks, Frank, and good morning, everyone. I hope I'm audible.
Yes, we can hear you.
Okay, thank you. So today with you, we have 3 teams from PwC, and this is a continuation of the presentation that we did past the end of May, where we had presentations from Kenya, Tanzania, Uganda, and Rwanda. At that time, we were presenting on the expected changes, partly based on the finance bills that were issued in Kenya and Uganda, and also on the proposals submitted by the stakeholders in the Tanzania case. And then in Rwanda, we presented on the reforms that were just announced. So today we're going to take you through what has actually passed through in the Finance Act. And I mean, as I'd mentioned earlier, during our previous presentation, Kenya and Uganda already had their finance bill. So whatever ended up coming through in the Finance Act, I mean, most of it was already presented in our previous session. So for them, they'll just do a very brief presentation focusing on the changes between the two. But for Tanzania, we didn't have the bill at that time. So most of the changes are completely new, and I will try to spend a bit more time going through those. Now, maybe without further ado, I will first welcome my colleagues from Kenya, Nairobi. Edward, if you can start us off with the changes happening in Kenya. Thank you.
Madam Johnson. Good afternoon, colleagues and everyone else. I'm Edward Paranta, Senior Manager within PwC Kenya's deals tax team. And I'll be taking you some of the high-level changes that have come through this year's Finance Act. I believe my colleague Rafael is to assist us with the slides. Rafael?
Okay, we are adding Rafael. So just a moment.
Okay. Thanks. As we wait for Rafael to join in, I could just go over on a high level, what we saw through the Finance Act, which is a theme that was carrying on from Kenya's finance bill that was early introduced that then went on to enactment into the law. What we are seeing is, there were not major cross-cutting changes as have previously been in prior Finance Acts, but the themes that cut across some of the changes introduced by the government this year is, repeal of exemptions, which means, shows that there's an effort to fiscally consolidate by the government. In cases where the exemptions on indirect taxes, we see, the movement of various items and goods from zero rating to exempt, and where they are in the exempt schedule moved to standard rating. But I'll just go over the ones that I think are very key topical ones at a high level. If you could please go to the Kenyan bit. Yes. Top on the agenda of our key changes was the limitation of carryover of tax losses to 5 years. Previously, we could carry forward tax losses indefinitely. What that meant is for the capital intensive sectors, the various allowances that you would have as a result of, having to invest heavily would be carried over indefinitely, and which made some of these sectors, such as the renewable energy sector areas, quite lucrative for various businesses as well. As a move that came in this year, that period has been lowered to 5 years. However, a change that was introduced following various participation from various members of the public was the cabinet secretary could now extend that duration for an additional 5 years. However, that will need to be on recommendation by the commissioner. It's likely to result in a bit of an administrative challenge as to, what are the qualifications for you to be added that extra 5 years. We've also had an introduction of advanced pricing agreements. This is a very welcome move, especially for transfer pricing cases. For multinationals with operations straddling across various countries, this is an opportunity ahead of the various transactions to agree on the arrangement or the arm's length nature of how you're going to remunerate each other, just to confirm that the revenue authority is aligned. This is likely to stop various transfer pricing assessments that we've seen in the recent past, which is a welcome move because it also does grant taxpayers a bit of certainty. We've had a change that has come through this year's Finance Act as well, which is a reduced corporate income tax rate for startups that are certified by the National Nairobi International Financial Authority Center Authority. The the reduced corporate income tax rate is for 15% for the first 3 years, and for the succeeding 4 years, a rate of 20%. A key concern, of course, is what are the key necessities for a startup to be certified, and what is the procedure that is to be undergone by a startup to be certified. And I believe the authority is coming out issuing guidance as we go on. It's an area definitely that I think various startups are looking to take advantage of that reduced corporate income tax rate. We've had a repeal of the digital asset tax, which is a move that is aimed at the government to encourage the uptake of these digital asset taxes. And we're likely to see, an increase insofar as these assets are concerned in Kenya. The rate that used to apply previously was 3%, now to 0%. In the finance bill that we did have, there was a move that was introduced, which has since been added on as part of the Finance Act, which is granting of the KRA's powers to issue agency notices to non-resident taxpayers. This is aimed at ensuring enforcement where we do have such taxes as significant economic presence tax, which applies to non-residents. This does give the KRA or arms the KRA with the requisite powers to go after such taxpayers to enforce the same. If I could please go over to the other key changes on tax administration front, there was an introduction of a provision allowing for offset of overpaid tax against VAT on imports. This does allow businesses to have a bit of cash flow, given that should you have any refunds that are due, you could use that to offset against your VAT. There's also been an extension of timelines to process refunds for the KRA from the initial duration of 90 days on applications to 120 days, and where there's post-audit from the duration of 120 daes to 180 days. So cumulatively, you're looking at about 300 days from the date you lodge your refund application to the date where the same has been successfully reviewed and issued. This results in a bit of a challenge for businesses, especially from a cash flow perspective, given that you'd have to wait a longer period to be able to access your refunds. There's also been an introduction of a provision requiring the KRA to give reasons for an assessment, for an amended assessment. This is a welcome move, given that it does allow taxpayers the opportunity to effectively or comprehensively respond where they're issued with an assessment. From an income tax front, there's been an introduction of capital allowances on expenditure that is incurred by telecommunication operators on acquisition of spectrum licenses. This is a significant investment for them, and the fact that the same is allowed to be expended over the duration is a welcome move, especially for the telecommunication operators. Significant economic presence tax is a tax that did come into operation in Kenya as of 27th of December 2024, and it came in to replace the digital services tax. And when it did come in, it did have a threshold of around Kenya shillings, which was set to apply, just to cushion the smaller businesses. It seems that the government feels that that was not necessary, and the 5 million threshold has been removed. Therefore, for non-residents who will have a significant economic presence in Kenya, they are likely to be required to account for this tax going forward, irrespective of your threshold. If I could please move on to the indirect taxes bit. On the value-added tax aspect, there's a reduction in the time allowed to lodge refund claims from the initial 24 months to 12 months. There's also been a reduction on the timeline for the bad debts refunds. Initially you needed to have about 3 years. Now that has been reduced to 2 years. 2 years is welcome, but I think the proposals that were coming in from various taxpayers across was for that period to be further to close to 1 year. There are various goods that have moved from exempt to standard rating. Some of them goods used in geothermal, from being exempted rather to standard rated, mining, oil and exploration, media storage devices. But we've also had some key exemptions that have come in through, especially clinical trial kits, as well as various goods that are imported for defense forces welfare services, as well as mosquito repellents. From an excise duty perspective, if I may, there's been imposition of excess duty on various imported goods, including tea, air capture machines, as well as non-refillable lighters. We've also had an introduction of excess duty on virtual assets service providers, which has been introduced at the rate of 10%. So in a nutshell, and to conclude on the Kenyan bit, the key themes that we're seeing across is the government is cutting back on the various exemptions that are available. And for cases where, there were various benefits that are awarded, the government is also having to scrutinize that closely. That is it from the Kenyan aspect, and I'll invite my colleagues from Uganda to take it over. Thank you.
Yes, thank you, everyone. Good morning. Hope you can all hear me. So my name is James Mubirwa, tax manager at PwC Uganda, and I'll be taking you through the major tax amendments that have come in this financial year. So this year we haven't really had so many amendments in comparison to the previous years, largely because we are heading towards an election period. So our amendments were quite few, and we won't spend so much time as opposed to the other presenters. So these are the 5 major changes that came in, which we are, of course, going to look at in detail in my next presentation. Sorry, in my next slides. And majorly, what we have seen coming is the waive of interest and penalties outstanding as at 30th June 2024, the expansion of the tax identification number to include NINs and business registration numbers and tax identification numbers issued by other foreign tax authorities, the 3-year exemption for small and medium enterprises, exemption from stamp duty of agreements and memorandum of agreements, as well as 1% import declaration levy on customs value for all imported goods for home use. So we're going to look at each of these in detail and some other ones as well. So, Johnson, if you could just move to the next slide. Okay. So to start off with tax administration, these were all, just before I proceed, these were all signed into law. So they came into effect on 1st July 2025. And first and foremost was the expansion of the definition of a tax identification number, which now includes national identification numbers, which are issued to resident individuals on their identity cards. It now includes business registration numbers, which are issued to businesses, as well as tax identification numbers issued by foreign tax authorities. So these can now be used as someone's or a business's tax identification number, and this is expected to ease registration for tax compliance purposes. Then we also saw a waiver of interest and penalties outstanding as at 30th June 2024, provided that the principal tax is paid before 30th June 2026. So this will be applied on a pro rata basis, meaning that the proportion of the principal tax that you pay is the equivalent proportion of the waiver and equivalent portion of the interest and penalties that would be waived. This is similar to previous waivers that we've had in the past 2 years of interest and penalties, and it is generally a welcome amendment, which is expected to increase compliance among taxpayers. The third one is a requirement for exempt persons to maintain the conditions and requirements under which the exemptions granted to them were given for the exemption period, failure of which they would be required to pay the tax that they should have paid should they not have been granted the exemption. So many a times we see exempt entities that do not continue to maintain the conditions under which the exemptions were granted during the exemption period. So as soon as they get the exemption letters, then they do not follow through with the conditions. So going forward, this will attract tax, and they will be required to pay that which they should have paid had they not been granted the exemption.
Under income tax, there's been an introduction of an exemption for businesses established by citizens after 1st July 2025, whose investment capital does not exceed 500 million shillings. So these businesses must not have benefited from any tax exemption in the past, and they would be required to register with the URA and file business information returns. So this is a welcome amendment. It's expected to increase compliance mainly among small and medium enterprises, and we really look forward to its application. There was also an expansion in the definition of reorganization as defined under the rollover relief provisions to extend the rollover relief provisions to transfers made between different persons. However, it wasn't really drafted well because the rollover relief provision, in which the term reorganization is used, still defines it within the context of resident companies. So transfers between resident companies are the ones that are granted rollover relief on their transfers. So we still will wait to see how it will be applied, but in our view, it may face some challenges. There's also been a restriction on application of the 5% digital service tax on digital services provided by non-residents to their associates in Uganda. So these will now be subject to the standard withholding tax of 15%, subject to application of a double taxation agreement, as opposed to the 5% that's applicable on digital services. There was also introduction of exemptions for the International Atomic Energy Agency, as well as the Bujadali hydropower project. Moving on to the next slide. Johnson, if you could just move to the next slide. Yeah, so under stamp duty, we had just one change, which is of major importance. That's to do with the exemption of agreements and memorandum of agreements from stamp duty. So previously, these were subject to stamp duty of 15,000 Uganda shillings, but now there will be no stamp duty applicable. In terms of excise duty, there's been an introduction of a 1% import declaration levy on the customs value of all goods imported into the country for home use. So this is expected to increase the taxes payable at customs. There's also an introduction of a 1.5% infrastructure levy on all goods cleared for home use. This is not specifically an introduction. It was already being applied. It's just that it wasn't really in the acts, but now it has been formalized and introduced. But it will not apply to certain goods as listed in the 5th schedule of ICMAC, as well as chapters 84 and 85 of ICMAC. So for Uganda, that's it in a nutshell. I'll hand it back to Johnson and the Tanzanian team. Thank you.
Thank you, James, and thanks, Edward, as well. Take the first part of the Tanzania changes, specifically the income tax and the tax administration, and then my colleague Fadela will take on the second part. To start on the tax administration, the first change that we have is with regard to the penalty for transfer pricing adjustment. So effective from July 2021, the penalty for transfer pricing adjustment was changed or updated to be equal to 100% of the tax shortfall. Now, by definition, that means the penalty is only applicable. There's an additional tax payable after a transfer pricing adjustment. Effectively, this was supposed to not capture the entities that are in a tax loss position. However, they have a different interpretation, and I mean, since then they have been trying to impose the penalty even in a situation where the companies are in a tax loss position, which caused a bit of a dispute. Now, the law has been changed to formalize that position. So if you're in a tax loss position and there is an adjustment that has been made, then there will be a transfer pricing penalty equal to 30% of the adjusted tax loss. So companies now, I mean, especially those that are in a tax loss position, need to just be make sure that their related party transactions are properly documented. And also, I mean, if you're a bit relaxed with regard to your tax exposures, you need probably to spend a bit more time to make sure that there is a proper defense for your related party transactions, because in case of an adjustment, in case of an audited an adjustment, then there will still be at least a penalty that is payable. Another change is on the deemed admission of the objection. We presented this in May, where we explained that the rules at that time was the objection is deemed to have been admitted when the tax deposit requirements have been met. But then there was a bit of ambiguity there in practice, especially in a situation where a deposit is not payable. E.g., I mean, if you're in a tax loss position again and there is nothing to be paid, then there is no requirement for a deposit. The law have now been changed to effectively the admission of objection to be the area of payment of the tax deposit or submission of the objection to cover those areas where there are gaps. The other changes on the deemed determination, and was to cover this, where our rules currently provide for a deemed determination after 6 months from the date of admission, in case the TRA have not issued determination. Now, the challenge was you will find in some scenario within those 6 months, the TRA might have issued a proposal, and in most instances, you'll find that the proposal has dropped some of the items, so some of the items might already have been agreed between the TRA and taxpayer. But then if a determination is not issued and deemed determination happens, then you're falling back all the way to the original adjusted assessment and disregarding, I mean, effectively beginning into appeal items that were already agreed during the dispute resolution process. So the law have now been updated to clarify or add these additional scenario, in a sense, stating that if a proposal was issued, then the assessment is deemed to have been determined in line with the proposal that you have issued. There's also an additional scenario in cases where a proposal is issued and the taxpayer does not respond to the proposal in the prescribed 30 days. Then the law also treats that as a deemed determination in line with the proposal that you have issued. Another change that we saw is in regard to the TRA's online system. So we already had provisions in our law which empower the Commissioner General to release an online system through which the taxpayer could be filing documents, as well as the TRA using it to service the document. The system is yet to be issued to date, but the laws have been now updated to add a bit more details in terms of the system. But also there is a provision that was introduced that the Commissioner General could now require a taxpayer to interface their electronic receipt system with that online system if such a notice is issued through a written request. Another change that we saw is on the tax residence, where the law now gives the power to the Commissioner General to recognize an resident as a Tanzanian tax resident and issue a tax residence certificate. This is done through a private ruling avenue. Something else that we saw is with regard to registration of small-scale traders. Again, I mean, this is a provision that was already there, but the changes came in this year, introducing, I mean, adding conditions or clarification on who qualifies as small-scale traders. And the conditions are two. First, the annual turnover of the trader should be below the minimum taxable income, which currently is around 3 million Tanzania shillings. And also the traders needs to have a TIN, tax identification number. But there is also a bit of a caveat that was introduced by the law, which says as much as you have the status, it does not automatically exempt you from I mean, there's not conclusive, even if you're given the status, there's not conclusive say that you've met the criteria. So effectively it leaves a room for the revenue authority to audit you in case they think you are granted the status, but maybe you have your annual turnover is above the amounts indicated in the threshold. Another change is on the disclosure of the information on contracted services. Again, these provisions are there where the companies in construction and extractive sector are supposed to disclose information on contractors and subcontractors within 30 days of signing an agreement. Now, the law has been changed to change that timeline to 30 days from commencement of work. And also it's provided a bit of an additional details on what are the information that are supposed to be submitted. Although there's still an ambiguity in terms of what is the template of the form and I mean other details, which we're all expecting that further guidelines will be issued by the Revenue Authority. The other change that we saw is in terms of the CG's power to restrain assets in case of unpaid taxes. So there is a provision in the Tax Administration Act which gives the CG power to restrain assets until the time when they can issue a jeopardy assessment or retrieve the unpaid taxes, but there was no now the law have been updated to put a period of 3 months, so the CG can only restrain such an asset for a period of 3 months. Moving on to the income tax, and I'll start with the two actually major highlights of the changes that we saw on the Finance Act this year. The first one, and trying to start on the positive note, is the inclusion of the positive retained earnings in the definition of equity. So in 2022, there was changed to remove retained earning in the definition of equity for the purpose of thin capitalization calculation, and this is the calculation of the interest that can be interest from the loans that can be deducted for corporate income tax purposes. Effectively, this put a lot of companies in a thinly capitalized position because now the equity was just restricted to the share capital. Now this is a positive change because it returns back the positive retained earning in the definition of equity, giving companies a bit of a buffer on their equity position. And another positive about the change is unlike the previous provision which you had included both positive and negative retained earning, or in other words, the accumulated losses, the law now just restricted to positive retained earnings. So if you have an accumulated losses, they won't be brought in to effectively erode your equity position. Another change that we saw is on the taxation of distributed profits, and there have been a lot of outcry on this change. But I mean, we have a change which effectively says if a company has not distributed, if a company has not done a distribution out of their profits within a period of 12 months from the year end, then the Revenue Authority can deem 30% of that profit to have been distributed. And that means that that amount will be subject to withholding tax. The general rate is 10%, although there are some different specific provision, like companies that are listed in the EAC have a reduced rate of 5%. There is still a bit of ambiguity. One is what is the minimum amount that the company has to distribute in a year to be exempted from this. Also, what are the profits? I mean, our general expectation is this refers to current year profit after tax, but that has not been defined in the law. Another change that we saw is the abolition of 10-year income tax exemption from special economic zone and export processing zone investors selling goods and services locally. This is generally introduced to harmonize the laws as we are going through the combination of these different authorities into one. The other thing that we saw is the increase in alternative minimum tax, which used to be 0.5%. It has now been increased to 1%. So again, companies that are in a tax loss position, you need to be prepared for this. I mean, the corporate income tax bill is going to go up. a little bit. Then there's also been an introduction of 2% income tax on sale of forest products. This will come effectively from 1st January 2026, as we're waiting for further clarification on its applicability and the personnel that will be captured by it. There's also been an exemption for companies whose annual turnover is below 500 million. Sorry, for individuals whose annual turnover is below 500 million and companies whose turnover is below 100 million. They don't necessarily need to have their CIT returns prepared or certified by a CPAPP. However, that requirement will still be there for those that are above the threshold. And then on the withholding tax, especially on the payments for resident, there has been an expansion to include hired motor vehicles. So we used to have these withholding tax on payments on rental payments, like for rent of land and buildings. So that has now been expanded to include motor vehicles, and the rate is 10%. So just something to bear in mind if you're hiring a motor vehicle. And that's also been a reduction of a threshold for a newly DSC limited company to be able to enjoy a reduced corporate income tax rate. So previously the threshold was 30%. So 30% of the stake needs to have been registered and owned by the public. That threshold has now been reduced to 25. So if you have 25% of your stake, then you can enjoy a reduced rate of 25% for the first 3 years. Lastly, there's been a revision on the income tax rate applicable to the investment by an resident. This is just to cement on something that we're already seeing in practice. So the law used to be 20% of the tax was supposed to be, 20% of the gain was supposed to be collected at the time of realization, but then there was no avenue on collection of the remaining 10%, and practically it was next to impossible for them unless they to come and disclose the 10%. The Revenue Authority had already caught up to it, and they had operated their system, and they were already having a 30% upfront. Now the law is just cementing that position, such that whenever you have a transaction, then for an less than 30% of the gain needs to be paid at the time of realization. That's that in terms of the tax administration and income tax. I will welcome Fadila to take us through the direct taxes. Thank you.
Thank you, Johnson. Good afternoon, everyone. I hope I'm audible. Okay, thanks. So yes, I'll take you through the VAT and excise changes. There have been several changes, and they're aimed at different goals, including protection of local industry, relief to some players in the agricultural and manufacturing sectors, some of them to widen the tax base, and some of them to align with the strategic goals of the government, for instance, the use of clean energy, and some to enhance compliance, and also clarificatory changes. So maybe if I start with VAT, there's for the first time we're introducing a reduced VAT rate of 16% instead of 18% on B2C purchases, where the payment is online. Basically, this is to enhance the cashless economy, but also to improve access to transaction data, and has increased transparency in collection of taxes, etc. So this change will take effect from 1st September 2025, and we're yet to see further guidance in terms of how this will be implemented, but also what kind of evidence will be required from the tax authority to demonstrate that the purchases were indeed made online. So this is a welcome move. And another change is the introduction of withholding VAT. I know our neighbors, Kenya, have it. I'm not sure about the others. And the introduction is that the VAT will be withheld by specific persons, including the Ministry of Finance, some government entities, and other VAT registered persons who will be appointed by the commissioner. So the withholding VAT rate will be 3% for goods and 6% for services. And the supplier will be required to account for the entire 18%. And then upon receiving the VAT withholding certificate, then they will be allowed to deduct the input VAT. And there's another change, which is, so maybe before I go on to the next one, again, because Tanzania has invested a lot in the systems, in the tax systems, it's also, so there's a question whether the cost of introducing this withholding VAT system outweighs the benefit, but also whether it's necessary given all the system investments that have been done in the past years, and we're also expecting an improved system that will come. I don't know if it's this year or the next year, but we've been promised an improved system. Another change is introduction of another VAT collection agency mechanism, and this is for assisted government entities. So what we don't know which entities these are yet, but what will happen is that instead of these government entities collecting VAT from the customers, the Commissioner General will be required to collect the entire consideration, and it is yet to be seen how this consideration will be distributed back to this entity so that they can use their money for operations and whatnot. They didn't include this change came through the bill, but there was also no specific audit that was tied to it, so it's unclear why this mechanism has been introduced. Another introduction is notification for failure to commence operations for intending traders. So this notification was introduced last year through the last year's Finance Act, but it was unclear what the notification meant and what the repercussions would be. So now the Finance Act has clarified that the CG is required to make a decision, and whether the intending trader who has failed to commence operations in the intended time will be granted an extension or not. And if they're not granted an extension, then they will automatically become VAT deregistered. We're seeing a lot of a big issue with this because, first of all, it's also unclear if there's a denial, whether there's another body or authority you can go to object, or what the mechanism will be. So if there's no mechanism, if this is the final decision, then maybe there's too much power in the hands of the CG. And with this change, it's also now time for those intending traders to also really consider carefully the time that they include in their VAT applications. And electronic service providers, the term online intermediation services has been expanded to include examples of what this includes. So it includes accommodation, online marketplaces, and online payment platforms. Again, there has been an extension of zero rating for locally produced fertilizers and locally manufactured garments. These have been, the zero rating was introduced, I think, maybe 3 years ago, and they used to provide an annual extension. But I see for fertilizers now it's 3 years, while for garments, they've continued to include the 1-year extension. Moving to exemptions, again, edible oil, similar to the zero rating, they grant yearly extensions. So the edible oil is also going to be exempt for another year. Abolished exemptions include purchase or importation of gaming supplies and bitumen. For gaming supplies, I think because they are also taxed under a special regime, so the expectation was that they would be exempt from VAT, but now they've been brought to the net. So all the gaming suppliers will now be required to register for VAT if they meet the threshold. New exemptions include VAT exemptions on pesticides, reinsurance transactions, supply of piped natural gas, specifically for being converted to CNG. So in the past, natural gas was taxable, which meant that it was taxable while CNG was exempt. So the CNG suppliers used to carry the input as a cost. So now the piped natural gas is exempt as well. So that value chain is now neutral. But this is specifically for CNG for fueling motor vehicles. Again, LPG cylinders for cooking and importation of carbonization furnace for exclusive use in manufacturing of briquettes is also exempt from VAT. Amendments or clarifications on various exemptions have also been provided. So for newspapers now, the exemption is limited to locally published newspapers and persons who are registered under the Media Services Act. VAT exemptions also now on tractor tires, dam liners, forks, axes can only be granted once there's an approval by the Minister for Agriculture. And there's also now a limitation of exemption to solar batteries to the extent that it's exclusively used in storage of solar power. So if it has a different use, then the exemption won't be applied. And also the exemption for aircraft engines and parts is now limited to specific HS codes. So it's no longer open. And if you're an importer of these items, you need to go and look at whether those items are under the specific HS codes. Yes, thank you. And on excise duty, one of the amendments is the definition of financial institutions. So in the past, there wasn't a definition, and there was a lot of disputes as to whether an entity is covered within the scope of excise duty or not. So this Finance Act has produced a definition, and this includes banks and financial institutions and microfinance service providers under Tier 1. There's also an extension of dutiable value for electronic communication services to include the use of cable, and while in the past it was just limited to mobile phones, wireless or fixed. And now excess duty license expiry is 12 months from the issuance. In the past, they used to expire by the end of December. So there's, I guess, more value for the money. If you get your license in September, then it will expire in the next year, August. The payment deferral deadline changed to the 25th of the following month. This is excise duty and not the last working day. So in the past, the act was not very clear, but now it is aligned to the filing date. And there's also reduced excise duty on imported and denatured ethyl alcohol and locally produced ethyl alcohol and energy drinks. The alcohol part, the excise duty was introduced last year, but then the rates were too high. And I think after several consultations, the rate has been reduced for both imported and local alcohol. And energy drinks, they're trying to promote the sectors. Again, there's also an introduction of an offset mechanism for wine manufacturers using ethanol. In the past, it was only limited to the spirits manufacturers. So to create a level playing field, they've now also included the wine manufacturers. And then there's also an exemption for undenatured alcohol used in non-alcohol goods, but then this has to be subject to the minister's approval. And then there's several excise duty increases. This includes pay-per-view from 5% to 7%, and imported furniture and natural gas from 0.5 to 0.55 Tanzanian shillings per cubic foot. And then there's also new excise duty. So we have an excise duty freeze, a calendar, which is a 3-year freeze. So the minister is not essentially allowed to increase excise duty on any item before the lapse of 3 years. But now we're also seeing some new excise duty introductions, which includes crisps, ice cream, sausages, soap, matches, jewelry, margarine, tableware, fireworks, electronic cigarettes, carbon-based excise, money transfer payment service providers. So all of these are new introductions, if I may say. And I also wanted to bring in industrial development levy. This was introduced last year on specific items which appear to be or are in abundance in the country, and so or in enough supply. So when they introduced this last year, the EAC originating goods were exempt from IDL, but now they've removed that exemption, meaning that even if you import these goods from EAC, goods of EAC origin into the country, they will be subjected to industrial development levy. I guess it calls for discussion, especially given comment from Mr. Jonathan and Mr. Njau. We need to rethink these levies, which might be detrimental to the objectives of the community. And therefore, there could be the structured stakeholder engagement that is required, but also for all the countries to look at levies that go by other names, but then, their introduction would be against the goals of the community. So again, the ideal schedule of goods subject to ideal have been revised, and the rate ranges from 5% to 15%, depending on the good. And the commissioner has been empowered to exempt persons from ideal in cases of public interest. That's it from me on the indirect tax changes. I will hand it over to Frank. Yeah, thank you.
Thank you very much, Fadila, Johnson, and the team, Edward. I would just like to take the opportunity now to open up the room for questions in case there is a question that you seek as a participant. You can raise your hand, and my colleague give you the mic, and you will be able to ask the question. Yes, we have Mr. Rabogo. Please, sir, you can go ahead.
Good afternoon, everybody. My name is Rabogo. Work with. First of all, I thank the team for putting up all this together. And once shared, we shall internalize it with the rest of the people in the business community to make sure that we can make informed decisions and prepare for the next budget. I hope I'm being heard.
Yes, we can hear you.
Okay. Mine will actually touch on Mr. Jonathan Sesanga. Whereas we look year in, year out, all these remission schemes being forwarded by different countries, I'm not saying maybe EABC also should put efforts. The regional duty remission schemes would make sense for the development of the region. The individual specific country remission schemes are really the regional market, because we do not look at what the neighbors, the capacities of the neighbors they have, where this particular country would import. I don't know how we can get together and fight that. That is my question to the panel. In short, for example, you'll find there's a lot of vegetable oil made in the region, but country A comes and asks remission on duties for raw materials. Yet they would buy from the neighboring countries which have excess capacity. And my other thing is, how do we push for regional remission schemes that can help the region grow together? And lastly, the other issue concerning the budget, it's actually a tax element. If you look now, there are a lot of commercial goods coming into the region. But we in the business sector don't have one portal where we can go to find what are the current tax rates or duty rates given, because the different items have gone either to 0 or 6 or some are 2. So we needed that information in the business sector on the commercial rates applicable in the region. Thank you so much, Adrian and team.
Thank you very much, Mr. Rabogo. Do we have any other question? Yes, Dr. Nyantae, karibu. Dr. Nyantai, you can go ahead and unmute your mic to speak. Dr. Nyantai, we still can't hear you and your mic is muted. So maybe we can move to the next person who raised a hand, Nimpe. Dr. Nyantai, maybe you can put your question on the chat.
Yeah, thank you very much. Mr. Nimpe from Burundi Bankers Association and the Executive Director and the board member for EABC for Burundi chapter. So I have one question regarding for promoting e-trade, e-commerce in the East Africa countries. In Burundi, we do have some challenges in putting the legal framework for e-commerce or e-trade because it is very quite new. And I saw that in the presentation, taxation, VAT on B, business to consumer B2C. And I do not know if it in Tanzania, it has been reduced from 18% to 16. But on other items, I saw that it can be remitted to 3 or 6, depending you are in the good services or in the good or services. Can I have some clarity on how e-trade is when it is on payment online are taxed in the different EAC member state? Thank you.
Thank you, Nimpe. Maybe now we can, after taking those questions, we can give it back to our presenters if they would be willing to give some responses. EABC.
Frank, maybe I can take the second question on the VAT from Dr. Samuel. So, sorry, am I audible?
Okay. Yes, you're audible.
Yeah. All right. Yeah, thanks. So the two changes on the 3 and 6% on goods and services, that's a different from the 16 reduced rate. So maybe just to clarify, the reduced rate of 16% applies where a business sells a good to a final consumer, a good or service to a final consumer, and that consumer makes the payment through online methods. That is, instead of paying physical cash, you make a digital payment. So you transfer maybe via bank or mobile, etc. So if you make that payment using digital means, then the supplier is allowed to reduce, is required to reduce the rate from 18% and actually charge you 16% instead. And then on the other 3% and 6%, that is a withholding VAT system. It just means that it operates like withholding tax under the income tax, meaning that when a supplier makes a sale to maybe a government entity and they charge 18%, which is the standard VAT rate, then the entity that is receiving that good will be required to first determine, is it a good or a service? If it's a good, then the entity will withhold 3% VAT and only pay 15% to the supplier. If it's a service, they will withhold 6% and only pay 12% to the supplier. And then after they withhold, then they'll give the supplier the withholding VAT certificate. So those are, so that is basically the two different changes in a nutshell. I hope I'm clear, and let me know if you need any further.
Yeah, you are much more clear. Maybe, is it the legal framework for which country? Is it the common taxation for EAC member state, or it's specifically for Tanzania?
Okay, Yeah, that is specific for Tanzania.
Okay. Yeah, maybe EAC,
Okay.
EAC Secretariat or EABC can maybe document us on what is happening for other EAC member states, for instance, in Kenya, because we have some issue on legal framework regarding the e-trade when it comes to be on a payment online. So if there are some response for that, I should be maybe more updated on that. Thank you.
Thank you, Fadila, and also Nimpe. So maybe through my ED, with the EAC, we know that the process of the review of the domestic taxes is still ongoing. So currently, we have very different regimes when it comes to some of these taxes, especially those related to excise and VAT. So as one of our recommendations to the EAC, that is what we have been pursuing as EABC, to fast track the process of the review so that we can have common frameworks. But so far, the mechanisms are different among the partner states. You still have a question, Nimpe?
Yes, my question
maybe to add in that particular area.
It is to request that EABC should maybe conduct a study so that the member states should know on how on the EAC region all these issues of taxation or e-trade is been doing. This is my request. Thank you.
Okay, thank you.
Thank you.
My
Very much, but also wanted to.
My English is not good. If it is not clear, I can maybe try to translate.
No, you are very clear. We can hear you and we can understand you very well.
Okay,
but we wanted to tell you, at EAC there is e-commerce strategy, and from that is payment system under e-commerce, and we'll make a follow-up to make sure that we harmonize the tax issue which are related to cross-border payment and the e-payment system in the region. So that is very clear to us, and we'll make a follow-up on that particular issue.
Yeah, can you share the EABC strategy on that after the meeting?
It is East Africa Community e-commerce strategy. We can share it. Please write your email in the chat, then we will share.
Thank you very much. Thank you. Thank you.
Thank you.
Thank you very much. So there is a hand from Manoj. Manoj, welcome. Manoj, we cannot hear you. Maybe you can try to unmute and speak again.
He has not unmute, I think. Yeah, okay.
Hello. Can you hear me?
Hello, we can hear you.
Okay. Yeah, it's regarding the industrial development levy imposed by Tanzania. Just wanted to understand that the speaker said the TRA commissioner is allowed to remove the duty, this import development levy based on the public interest. Can we know exactly what this is meant by? I mean, what is the public interest meant by? Hello?
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 Yeah,
Yes, we can.
I could hear your question. So unfortunately, at the moment, there isn't like further guidance on what public interest entails. And therefore, if an entity wants that exemption, then there would be a requirement to engage with the Commissioner General and see whether the reasons they have would suffice, or would qualify as public interest.
Okay. All right. Just wanted clarity on that. Thank you.
All right. Thanks.
And maybe to chip in, Fadila, any entity can write or affected entity or any entity to the commissioner.
So it says an entity can, so I think it's either upon application, but I don't know if it can be steered from the Commissioner General himself. But I think it's the entity probably making that request to the Commissioner General. So it doesn't have any specific, it just says an entity can request, the Commissioner is empowered to give this exemption in the case of public interest. So if you feel possibly that this IDL is maybe crippling the business and it has an economic impact in Tanzania at large, and you can demonstrate that, then possibly you can make that request and the Commissioner can guide accordingly. Yeah.
Okay, thank you very much.
Thank you.
Thanks.
Okay, thank you everyone for the questions. I don't see if there are any other questions. A lot of the comments are on us sharing the presentation and we'll share them. Most of you in this meeting have registered with your emails. So once we finalize our webinar today, we'll be able to share the presentations that were done during this meeting. So unless there's any other question. Yes.
There is a question from Rwambogo where he was asking, actually, I'm not sure if Jonathan is still in. He was asking the challenge where you find, for example, a country when he's asking for duty remission, a company is only looking the country and is not bringing into context. Maybe that input is available in the region and how we can make sure that when we are asking for duty remission, especially country-specific duty remission, we need to put into consideration the region as a whole, because input can be, maybe it's not sufficient available in your country, but is available in other country. How this statistic can be available to the region and to the private sector, so that when we are coming up with a duty remission, is taking consideration the region and not only country. That is one. And second, I think he was also asking, how can we come up with a regional duty remission rather than, because we have very few products which actually use regional duty remission. Maybe, for example, sugar for industrial use. How those other products which are enjoying specific duty remission across the country can now do away with the specific and go to regional duty remission. I think that was from the our goodwill ambassador Rambogo from Uganda.
Chair, I'm on.
Yes, sir.
Yeah.
Can you assist in that particular area also?
Okay, thanks so much. Yes, I just wanted to say that yes, we are facing this challenge that because normally there are discussions which go on when these submissions are made, and at times other partner states can submit and provide information on availability of goods on which other countries are maybe seeking either stop application or duty remission. But we also carry out studies from time to time, because when we see persistent requests, we normally carry out to study on specific sectors to find out the production across the region, so that we really justify that actually there's a shortage of production of a particular item, which another partner state is asking for a duty remission. These studies are a bit expensive, but we normally carry them out, specifically on sectors maybe where we feel that there's need to harmonize. So we are always working with the other partner states to address some of these challenges. And actually, this is a real concern that why would a particular partner state go and they buy goods elsewhere when they are available in another partner state. So this is a critical point of concern, and maybe because we are providing these gazettes, I don't know whether EABC also has the capacity and resources to also review the trend, maybe of these submissions and the provisions, so that maybe they can also do some analysis on some of the specific sectors to find out that why is there a persistent request for data remission when within the region. So we will request that if EABC maybe can also get support, and they also carry out their own studies to inform policy. Thank you.
Thank you very much, Jonathan, for that. But also, I have seen some EAC report where they are saying, for example, currently the EAC can pilot some of the product where they are looking, there is a lot of adjustment, and maybe they can come up with a list of at least 5 products which they think maybe it is frequently adjusted by maybe all EAC partner state, then agreed on the regional, maybe if it is rising of import duty or lowering, depending on how country have been adjusting that particular tariff line.
Yeah, we have been making proposals. Let me give you an example, for example, of wheat. Definitely, there are some countries which have advantage in production of wheat, but overall, the quantities maybe are not sufficient to cover the whole region. So you find that we still have some items where you find that it's a delicate balancing act. You don't want to disadvantage those who are already in that sector, and at the same time, you don't want to open it up. So some of them, the CET rate has remained as is, but it is managed through an annual stage of application. But the point is taken. We might start producing maybe reports on where we have seen some trends, and maybe it results into a review, and maybe agreeing on maybe either a lower rate to support. Yeah, thanks so much.
Okay. Back to you, Frank.
Yes, thank you very much. And I think also one of the requests from Mr. Rabogo was also to include COMESA rates in our discussions. So maybe that is something we will look on as we make these webinars next time, so that we can also either provide that information if we'll be able to access it. I don't know if there is any other question. Maybe we welcome one last question. But if there are none, ED, maybe we can just, Gillian. Yes, please unmute.
Yes, thank you very much. My name is Gillian. I work for the Eastern Africa Grain Council. I have followed through your presentation on the changes that would be there for the 3 countries. I had put my question in the chat, but I'll quickly just go through it. From where you sit and from the analysis that you've done, are there any major implications for the grain traders and farmers, especially from farm to fork, with these changes that you've analyzed so far? Thank you.
Yeah, maybe we turn that question to our experts from PwC in case if there are any tax measures that they think will be touching specifically to the grain sector.
Hi, so maybe I'll start on Tanzania. Yeah, I'll probably say no. The only change that we have is the 2% income tax on sale of forest products, which I presume It's not what Jillian is after. I don't know. I will probably ask my colleagues in Kenya and Uganda to comment in case there is anything. But for Tanzania, the laws remain as they are for that particular sector. Thanks.
Thanks, Johnson. I think from a Kenyan perspective, not as much as well. There's not a significant change will not that targeted the green sector mainly.
Yeah, so hi team. Same applies to Uganda. We haven't seen any changes coming this year in that regard.
Thank you, colleagues. And I think maybe for Kenya, there was a reform which we had asked last time. And maybe colleagues from PwC, you can confirm the one on excise duty for eggs, potatoes, and I believe there was a measure to exempt those products.
Frank, I'll need to confirm that and I could come back to you in writing on it.
Okay, no problem. So once again, I think I will just thank everyone for their time. And now I would just like to take the opportunity to welcome the closing remarks from our chairperson, if he is there. But if he is not, maybe our acting ED can just give the closing remarks for this webinar.
Oh, okay, thank you very much, Frank. Let me take this opportunity on behalf of our chairperson to thank our actually collaborators, PwC from Tanzania, Uganda, Kenya, for actually collaborating with us in preparation for this webinar. I think the webinar also without actually forgetting the East Africa community for coming up with an analysis on the common external tariff and the adjustment which have been made for this year. And I think the webinar and the presentation have been very insightful for the private sector. And we challenge the private sector to look about those changes and how they impact their businesses. And if they have any recommendation on how things will be done differently, we are very much willing to receive those recommendations and look how we can positively impact the budget. I understand some private sector, they are really affected with some of the changes, and they are looking on how they can advocate for change of some of the tax, which they think maybe they are discriminatory in terms of the EAC originating goods. We are also looking for those comments, and we'll try to address some of those challenges which are coming up with our budget. But we are urging the private sector to be very neat in looking and participating in the pre-budget national consultation to ensure that the regional trade and investment is not disrupted by the taxes changes. So we thank you all for participating, and we are looking forward for more collaboration in terms of improving business conducive in our region. Thank you very much. I think we are closing the webinar.
Yes. Thank you very much, ED, and thanks everyone. And as promised, to share the presentations with you. But once again, to urge the participants, EABC is organizing our East Africa Business and Investment Summit in Nairobi in the month of October. 16 and 17. So kindly visit our website. You find a way to register, way to, even if you want to exhibit and to participate as a stakeholder, kindly contact us.
Thank you and bye.
Bye.
Goodbye.
Thank you. Goodbye.
Okay, goodbye, goodbye.